Welcome back, students. So today we are going to see a new chapter, Depreciation Accounting. So what is depreciation? So it is a gradual and permanent decrease in the value of an asset. So let us now look into Carter's definition. So he defines depreciation as the gradual and permanent decrease in the value of an asset from any cause. So what are the causes of depreciation? Why there is a gradual and permanent decrease in the value of asset? First one is wear and tear. So when we use an asset more and more, it loses its efficiency. You call that as wear and tear. The second one is efflection of time. Efflex of time is that certain assets, whether it is used or not, becomes potentially less useful within the passage of time. So if you are not using or whether you are using, doesn't matter. Certain assets, as human beings, we do have a life. So we have an average life expectancy, right? Similarly, all the assets do have a life. Say for example, 10 years. So whether you are using during that time or not, over the passage of time, it becomes less useful. And you call it as efflux of time. Third one is obsolescence. So the value of assets gets reduced due to the availability of upgraded alternatives. So this happens mainly because of new inventions and innovations. When new things are coming up, the old one gets outdated. You call this as obsolescence. The next one is inadequacy for the purpose. Sometimes the use of assets may be stopped due to their inadequacy of the purpose. When it doesn't solve the purpose or serve the purpose, its value becomes reduced. So these may become inadequate due to expansion in the capacity of a firm. So when there is an expansion, you may move in for an upgraded technology or in a very bigger one. So the old one becomes inadequate. The next one is lack of maintenance. When we don't maintain an asset properly, if you maintain an asset properly, it will naturally increase the life of the asset. When there is no proper maintenance, there is a possibility of more depreciation. Then the last point is abnormal factors. It can be due to some natural calamities or fire accidents. So all these things cause damage to the asset. So decline in the usefulness of an asset may be caused by abnormal factors like damage due to fire accidents, natural calamities. So these may even lead to the state of an asset being discarded. So when there is a heavy damage due to fire or any other natural calamity, then the asset may not be useful anymore. We have to discard that. And we need to replace a new asset. So these are the causes for depreciation. Why do we provide depreciation? Objectives. Objectives of providing depreciation. First thing is to find out the true profit or loss. So we already know about the matching principle, right? The expenses incurred during period must be matched with the revenue earned during that period. So when an asset is used for generating income for the business, the cost of the asset attributable to the use, that is, the reduction in the book value of the asset, should be proportionate. Okay, so only through this we can find out the true profit or loss. The second one is to present the true and fair view of financial position. So when the depreciation is being charged on fixed assets, the book value of fixed assets are reduced to the extent and the remaining value is shown in the balance sheet. So the cost minus the value of the amount of depreciation gives you the book value. So we will be showing the book value. Okay. Then the next one is to facilitate replacement of fixed assets. So when an fixed asset gets owned out, so we may not be using that anymore. So it's time for replacement of a new asset. Only through the provision of depreciation we'll be able to facilitate this replacement of fixed assets. The next one is to avail tax benefits. So as per the Indian Income Tax Act, while computing tax on business income, depreciation is deductible from income. So depreciation is computed and charged to profit and loss account in order to reduce the tax liability. Then to comply with legal requirements. So depreciation is provided on fixed assets in order to comply with the provisions of the Indian Companies Act of 2013. So it requires companies to provide depreciation on fixed assets before declaring dividend to its shareholders. So these are the main objectives of providing depreciation. So next one is the methods of providing depreciation. So how to compute this? So how to provide depreciation? So there are almost 9 methods of providing depreciation. Straight line or the original cost or fixed installment method. So all the 3 are the same. So straight line or original cost or fixed installment method. In short, you call it as SLM, straight line method. Okay. The second one is the diminishing balance or written down value method, WDV. So in this chapter, we will be concentrating on only the first 2 methods. Okay. The remaining methods, you have to know what is what. That's it. So we will concentrate, we'll focus only on the first 2 methods. All the exercise problems are based only on the first 2 methods. So third one is the sum of years of digit method. Fourth is the machine hour rate method. How many hours we utilize or run a machine based on which the depreciation may be provided. Then depletion. So in case of mines, natural resources, when their value decreases, we call it as depletion. For fixed assets, we use the term depreciation. For these natural resources, we use the term depletion. For intangible assets like goodwill, trademark, patent, we use the term amortization. These are the 3 different terms which are being used for the decrease in the value of an asset. So let me repeat. For the decrease in the value of fixed assets, we use the term depreciation. For natural resources, when the value decreases, we use the term depletion. And for intangible assets like goodwill, trademark, patent, copyrights, for all these things, we use the term amortization. Then we have annuity method, revaluation method, sinking fund method, and insurance policy method. Now, let us look into the first method of providing depreciation, the straight line method. So, we are going to use this formula to find out the amount of depreciation. So original cost of the asset minus scrap value divided by estimated life of the asset. So what is the original cost? It is the cost of the asset including the installation charges, erection charges, setting up cost, freight charges, all these things put together gives the original cost of the asset. Scrap value or residual value. So it is the amount which is expected to be realized at the end of the estimated life. Say for example, the estimated life to be 10 years. At the end of the 10th year, what is the expected amount to be realized when you make a sale? So when you sell the asset at the end of the estimated life, what is the amount to be realized? The expected amount to be realized at the end of the estimated life, you call that as scrap value or residual value. So original cost of the asset minus scrap value divided by estimated life of the asset gives us the amount of depreciation. Under straight line method, the amount of depreciation is the same for all the years. So how to calculate rate of depreciation? The amount of depreciation divided by the original cost into 100 gives us the rate of depreciation. Now let us move on to the exercise problem number 1. Here they have given original cost 40,000, erection charges 2,000, estimated life is 5 years. And they have asked us to calculate the amount of depreciation. Now we are going to use the formula original cost minus scrap value divided by estimated life. So we don't have any scrap value, but the original cost must also, we have to include the erection charges, right? So 40,000 plus 2,000, 42,000 will be the original cost now. So 42,000 minus 0, there is no scrap value given, so I am putting 0 there, divided by 5. So 42,000 divided by 5 gives you 8,400. This is the amount of depreciation. The second exercise problem, cost of the building 50,000, residual value is 5,000, life of the asset is 10 years. So they have asked us to calculate the amount of depreciation and the rate of depreciation. Now let us calculate the amount of depreciation. We will use the formula cost of the asset minus residual value divided by life of the asset. So cost of the asset they have already given 50,000 minus residual value 5,000 divided by the life of the asset 10 years. So 45,000 divided by 10 gives us 4,500. So this is the amount of depreciation. So 4,500 rupees 4,500. Then how to calculate the rate of depreciation? We will take the amount of depreciation by original cost into 100 gives us the rate of depreciation. So the amount of depreciation is 4,500 divided by original cost 50,000 into 100. We will be getting 9%. So able to understand this?